Canada, Tiff Macklem. Tiff Macklem was appointed Governor of the Bank of Canada in June 2020 for a 7-year term. Mr. Macklem first joined the Bank of Canada in 1984 and held various senior positions, including Chief of Research and Advisor to the Governor. He was appointed Deputy Governor in 2004 and Senior Deputy Governor in 2010. During the global financial crisis, Mr. Macklem was Associate Deputy Administrator at the Department of Finance and represented Canada at the G7, the G20, and the Financial Stability Board. From 2014 until his appointment as Governor, Mr. Macklem was the Dean of Rotman School of Management at the University of Toronto. So please join me in welcoming Tiff Macklem.
Well, thanks, Norm, for that very warm welcome. How wonderful it is to be here in Mississauga. And I can't resist. What a hockey game last night. Canadian talent, Canadian speed, Canadian grit on full display. It is a real pleasure to be here, and I do want to thank the Mississauga Board of Trade and the Oakville Chamber of Commerce for inviting me. When I accepted this invitation months ago, I intended to use this opportunity to launch the renewal process for our monetary policy framework. The framework sets out the goal for monetary policy, to maintain price stability over time. Thank you, Mohammed. In simple terms, we aim for a 2% inflation target, so inflation remains within a range of 1% to 3% most of the time. We renew the framework in agreement with the Government of Canada every 5 years. This is a strength of our system. It gives us the opportunity to review the performance and consider whether the framework remains the best one for the future. Well, that was my speech topic until President Trump announced significant and broad-based tariffs on Canadian exports. While the new tariffs have not yet taken effect, the uncertainty around U.S. trade policy is already affecting our economy. And if the United States starts a protracted trade war, the consequences could be severe. I know this is on everyone's mind, and that's why I've adjusted my remarks. President Trump wants to use tariffs as an instrument of U.S. policy. What that means for the global economy and for the Canada-U.S. trade relationship is highly uncertain. We don't know what tariffs will be imposed, when they'll start, how long they'll last. We don't even really know to what end. We also don't know how Canada and other countries will respond. And even when we know more, it is going to be hard to predict the economic impacts because we haven't experienced such broad-based tariffs since the 1930s. What looks inescapable, however, is that a structural change is upon us. Increased trade friction with the United States is a new reality. While there are still more questions than answers, I'm going to use my remarks to speak to some of the key questions. What could this structural change look like? How would a protracted trade conflict affect the Canadian economy in both the short run and the long run? What can monetary policy do and not do? And what could Canada do beyond the scope of monetary policy to compensate at least for some of the consequences of increased trade friction with the United States? Then I'm going to turn back to my original plan and launch the latest review of our monetary policy framework. The future does look different than the past, and it's critical that we get going on this review. Now, before I explain how trade friction will hurt our economy, let me explain how open trade has helped both Canada and the United States. After World War II, the Allied nations created the Bretton Woods institutions and progressively reduced tariffs. They wanted to avoid the protectionism and instability of the Great Depression. And they believed that economic cooperation, including open trade, was the best way to maintain peace and build prosperity. In 1965, Canada and the United States signed the Auto Pact. Open trade in the auto sector allowed for economies of scale and specialization. Productivity went up, and prices of motor vehicles went down in both countries. The success of the Auto Pact prompted more appetite for open trade. The Canada-U.S. Free Trade Agreement, signed in 1988, broadened the economic gains considerably. Manufacturing productivity in Canada increased about 14%. In 1994, with NAFTA, the trade relationship expanded further to include Mexico. And in 2020, this agreement was updated and renewed during the first Trump presidency. The durability of this trade agreement speaks to the benefits to all three countries. For roughly the past 60 years, our bilateral trade relationship with the United States has increased. Today, about 3/4 of Canada's goods exports flow to the United States. Canada is also the #1 export destination for the United States and the largest export destination partner for 32 of 50 states. Canada's biggest export to the United States is energy. Canadian oil, natural gas, gasoline, and electricity literally fuel the U.S. economy at a price no one else in the world can provide. And if we exclude our energy exports, the United States actually has a trade surplus with Canada. Open trade between Canada and the United States has benefited both countries, increasing efficiency, spurring investment, boosting productivity, and raising standards of living. A significant increase in tariffs will kick all this into reverse. The economic consequences of a protracted trade conflict would be severe, but it would be a very different shock than the COVID-19 shock. In the pandemic, we had a steep recession followed by a rapid recovery as the economy reopened. This time, if tariffs are long-lasting and broad-based, there won't be a bounce back. We may eventually regain our current rate of growth, but the level of output will be permanently lower. It's more than a shock. It's a structural change. Now, to get an estimate of how much lower production and incomes would be, you need an economic model. And as described in our January Monetary Policy Report, we have combined a multi-sector, multi-country trade model with our main macroeconomic models of the Canadian economy to examine the impacts of a protracted trade conflict. Now, I do want to emphasize that models are imperfect at the best of times. So we need to be cautious, and we need, in this case, to be more cautious than usual because the lack of historical experience with big increases in tariffs. So please do not interpret these results as a forecast, but more as an illustration of the economic impacts. So with that caveat, Chart 2 shows an estimate of the long-run effects of higher tariffs. The gray line shows the bank's projection from our January MPR, which is our base case projection without tariffs. Economic output is steadily climbing. The blue line shows the impact of the anticipated tariffs based on the executive order signed by President Trump on February 1st, plus retaliatory tariffs by Canada. That executive order calls for 25% tariffs on non-energy exports and 10% on energy exports to the United States. Based on this scenario, economic output initially falls, then it steadies and begins to grow again, but on a path that is 2.5% lower. Now, models can also help us understand the impact of tariffs in the short run. The effects I'm going to show you are expressed relative to that January projection. which I just showed you the baseline. Now, the first thing we would see is a marked decline in exports. As Canadian goods become more expensive, U.S. demand for those goods would decline. A lower Canadian dollar would provide a partial offset. In our model, with the scenario based on the February 1 executive order, exports fall by about 8.5% in the year after tariffs takes effect. That's the green line. Canadian exporters respond by cutting production and laying off workers. With exports to the United States accounting for roughly 1/4 of our national income, the shock will be felt across Canada. Lower export revenues would reduce household income, and retaliatory tariffs would raise the prices of many consumer goods. As a result, consumer spending on everything from cars to entertainment to housing would slow. In this scenario, consumption, the purple line, declines by more than 2% by mid-2027. With export and consumer demand weakening, Canadian businesses would also cut their investment spending, and higher costs and lower profit margins would restrain investment further. With retaliatory tariffs on some goods and a lower Canadian dollar, businesses will face higher import costs. Canadian businesses, and I'm looking at them, buy roughly half of their machinery and equipment from the United States. In addition, profit margins are squeezed because higher costs are gradually passed on to final goods prices in Canada. So you got lower sales, higher costs, and reduced profit. Not surprisingly, they all combine to pull down business investment substantially. All told, business investment shown by the orange line declines by almost 12% by early 2026, 1 year after tariffs are imposed. So what would this all mean for economic growth? Well, in our January projection with no tariffs, we forecast growth of about 1.8% in both 2025 and 2026. But in the tariff scenario, the level of Canadian output falls almost 3% over 2 years. That's the blue line. That implies tariffs would all but wipe out growth in the economy for those 2 years. Finally, a trade conflict would push up prices even as demand weakens. Retaliatory tariffs on U.S. exports to Canada feed into the consumer price index. Roughly 13% of Canada's CPI basket is made up of goods imported from the United States. The depreciation of the Canadian dollar also increases the cost of all imported goods and services. Finally, integrated supply chains means tariffs can add costs at multiple stages of production. In our tariff scenario, the factors pushing up prices more than offset the downward pressure from weaker demand. So inflation rises. In January, the bank projected that inflation would remain close to the 2% target for the next 2 years. Tariffs would temporarily push inflation above 2%. If the economy is on a lower path and there's upward pressure on inflation, what's the response of monetary policy in the Bank of Canada? I know, that's what everybody really wants to know. What can I say? What the bank can do is we can help the economy adjust. With inflation now back around the 2% target, we are better positioned to contribute to economic stability. However, with a single instrument, our policy interest rate, we can't lean against weaker output and higher inflation at the same time. As we consider our monetary policy response, we will need to carefully assess the downward pressure on inflation from weakness in the economy against the upward pressure on inflation from higher import prices and supply chain disruptions. Unlike the pandemic, if tariffs persist, there will be no economic bounce back. Long-lasting tariffs mean lower potential output because our economy works less efficiently. Monetary policy cannot restore that lost supply. At most, it can smooth the decline in demand. The sharp fall in exports and investment when tariffs are imposed, combined with weaker consumption, means initially demand would fall more than potential output, creating excess supply in the economy. Provided the inflationary impact of tariffs is not too big, monetary policy can help smooth the adjustment by supporting demand so it doesn't weaken too much more than supply. But how much support monetary policy can provide is constrained by the need to control inflation. The initial impact of tariffs is a one-time rise in the level of consumer prices. Monetary policy cannot change that. What monetary policy can and must do is ensure that higher prices do not become ongoing inflation. This means making sure that households and businesses continue to expect inflation to remain well anchored on the 2% target. Simply put, monetary policy needs to ensure that the increase in inflation is temporary. Now, I hope, we all hope, Canada can continue open trade with the United States. A trusted open trade relationship benefits both countries. But if we are faced with a prolonged trade conflict, the only way to offset this negative structural change is with a positive structural change. Now, structural policies are appropriately the responsibility of elected governments and parliaments, not the Bank of Canada. So I will tread lightly here. The bank has previously highlighted Canada's productivity challenge, and it's good to see more focus by federal and provincial governments on structural reforms to increase productivity and investment by strengthening our economic union. Removing rules that restrict interprovincial trade or harmonizing or mutually recognizing provincial regulations could provide some offset to the increased trade friction with the United States. Provinces could also make it easier for workers to move within Canada by mutually recognizing different labor accreditations. There is also scope for all levels of government to reduce the timelines and uncertainty related to regulatory approvals. And better east-west transportation links would make trade within Canada less expensive and help get Canadian products to overseas markets. Again, it's not for the Bank of Canada to prescribe these policies or investments. But higher productivity means higher potential output and more capacity for growth without inflation. As Canada confronts the reality of increased trade friction with the United States, a concerted focus on productivity has rarely been more important. In some ways, the U.S. tariff threat is part of a broader global economic shift. The structural tailwinds of peace, globalization, and demographics that helped keep inflation low are turning to headwinds, and the world looks increasingly shock-prone. Higher long-term interest rates, elevated sovereign debt, and slower economic growth have made the global economy more vulnerable. Compounding these are war, rising trade protectionism, and economic fragmentation. Canada also has a structural supply challenge in its housing market. For years, the supply of housing has not kept up with demand, and housing affordability has deteriorated. These shifts all have implications for inflation. They may put more upward pressure on prices, and a more shock-prone world means more volatility in inflation. And that brings me back to my original speech topic, the bank's flexible inflation targeting framework. Since 1995, the 2% target has been jointly agreed with the Government of Canada. This gives it political legitimacy, and it gives the Bank of Canada the operational independence to conduct monetary policy. For the 25 years leading up to the pandemic, inflation was low and stable. But the pandemic tested the framework like never before. We faced huge shocks to both demand and supply, a deep recession, and a rapid rebound. As the economy reopened, inflation rose sharply, hitting 8%. Guided by the framework, the bank raised our policy interest rate forcefully to bring inflation back down. And since last summer, inflation has been close to 2%, and we've cut our policy rate to keep it there. In short, the framework was tested, and it proved resilient. The measure of the framework's success is not only whether inflation is close to 2%, it's also how the framework performs in the face of shocks, especially big ones. The next renewal of the framework is set for 2026, and the review begins now. Our focus in this review will be how we can improve the framework and its implementation to best address structural changes. We will consider several questions. With more supply shocks, do we need a richer playbook for monetary policy? The usual response to supply shocks is to look through them because they have a temporary impact on inflation. But we saw in the pandemic that supply shocks can be persistent and they can accumulate. The best response will depend on the situation. In a world with more volatility, how should we measure underlying inflation? No single measure of core inflation works for all circumstances. What measures are most robust in a shock-prone world? Should we focus on 2 or 3 preferred measures, or is a broader approach better? We also want to consider the interaction of monetary policy and housing. Housing affordability is a major concern for Canadians, and rising housing costs feed inflation. But monetary policy cannot directly increase housing supply. That's an issue for elected governments at all levels. Still, we must consider how monetary policy affects housing demand and supply, and how the imbalance between them feeds inflation in shelter prices. The question of housing market imbalances also matters for the measurement of underlying inflation. Does persistently high inflation in shelter prices distort our measures of core inflation? Finally, each time we've reviewed our framework, we've asked about the inflation target itself. In our 5 reviews since 1995, we've considered whether 2% is the right target, and we've weighed alternatives, including price level targeting and nominal GDP targeting, among others. Each time, we've concluded that 2% inflation is the right target. Canadians have told us they don't want higher inflation. They've also told us the 2% target is well known and well understood. That has helped anchor inflation expectations through thick and thin, including through the pandemic crisis. With trade conflict on our doorstep, we need to focus our resources on the most pressing and important issues for our monetary policy framework. In my view, now is not the time to question the anchor that has proven so effective in achieving price stability. Okay, we have covered a lot of ground. It's time for me to wrap up. L'économie canadienne est sur des bases plus solides. L'inflation est revenue à la cible. Les taux d'intérêt ont beaucoup baissé et les dépenses des ménages se sont renforcées. Mais une nouvelle crise est à nos portes. Si les menaces tarifaires américaines se concrétisent, les conséquences économiques seront graves. Un conflit commercial de longue durée ferait chuter les exportations et les investissements. Cela mènerait à des pertes d'emplois et ferait monter l'inflation dans les prochaines années. En plus, ça ferait baisser notre niveau de vie à long terme. Déjà, l'incertitude cause des dommages. Canada's economy is on a better footing. Inflation has returned to the target, interest rates have come down substantially, and household spending has strengthened. But a new crisis is on the horizon. If U.S. tariffs play out as threatened, the economic impact could be severe. A protracted trade conflict would sharply reduce exports and investment. It will cost jobs and boost inflation in the next few years and lower our standard of living in the long run. The uncertainty alone is already causing harm. Central banks can do little to mitigate the damage caused by a trade war. Our role will be to balance the upside risk to inflation from higher costs with the downside risks from weaker demand. Our focus will be to help smooth the painful adjustment to a lower path for the economy while preventing price increases from becoming higher ongoing inflation. The inflation targeting framework has proven both flexible and durable. Its review every 5 years is an opportunity to reflect on what's working well and what could be improved. The framework proved itself time and again, and the bar for change is high. But the world economy is shifting. At the Bank of Canada, we are committed to ensuring we are as prepared as possible for the changes to come. Thank you very much.
Thank you very much, Governor. I'm just making sure my mic's working. I think it is. Thank you again for joining the Oakville Chamber and the Mississauga Board of Trade today and for these insightful comments. I can only think, and just thinking back to last night, that setting monetary policy in this uber uncertain environment, just fraught with so much uncertainty, must be like going into overtime, where, you want to make sure you don't make that one move that could inadvertently hurt the economy. But if we play our game, as I'm hearing you say, our proven game with regard to the interest rate target and the framework, then that's our best chance to withstand. So we're going to dive a little deeper into some of the points you made, and we'll start on the issue of the day in terms of the threatened U.S. tariffs. And so they do continue to loom over our economy. As of today, we've heard from the president that softwood lumber could be on the table as well in terms of a global trade tariff. And we know that I think 25% of lumber imported to the U.S. is from Canada. And so certainly a concern for our economy and at the Mississauga Board of Trade, some of our members too. So while we know that you cannot discuss policy enacted by elected officials, whether it's the possibility of retaliatory tariffs or fiscal or tax policy, what implications, Governor, do you see for monetary policy as a result of the American tariffs? And you've alluded to some of this now, and I understand this was factored into the recent quarter point reduction. I know there's another rate announcement in March as well. How does all of this factor in?
Well, I'll start by going back to our January decision. Setting tariffs aside for a second, what we see is an economy, inflation's back to 2%. We've lowered our policy rate from 5% to 3%, 200 basis points, substantial decrease. And we are seeing that flowing through to increased household spending. Households have more money to spend, and they're spending it, and growth is picking up. When we looked at the economy back in January, I think we were encouraged by that. At the same time, we did want to be assured that increase in growth we were seeing would be sustained, and against that background, a small further reduction in interest rates made some sense. But the other thing that was increasingly on our mind was that the uncertainty created by tariffs just itself. If you're a business, I'm looking at many of you are running businesses. And certainly what we're hearing from businesses, and I fully understand it, is you're delaying your investment decisions. Who wouldn't? You're trying to navigate this uncertainty. You're looking at different contingency plans. Your supply chains are already getting disrupted. So you're delaying those decisions. And against that background, you're going to see a weaker investment, and I think that is going to start to spill into weaker consumer confidence. Since January, we're just starting to get that information, but you are starting to see some evidence of that. So yes, the fact, this increased uncertainty did weigh on our decision, and it reinforced our decision to cut by 25 basis points. Going forward, well, I tried to lay out in my remarks with lots of with charts and simulations, but let me just try to boil it down to a couple of key points. The first point I really wanted to stress is that, unfortunately, permanently higher tariffs means a permanently lower level of a permanently lower output path for the economy. And unfortunately, monetary policy can't fix that. Tariffs mean the economy is going to work less efficiently. There's going to be less investment. And so the path for output is going to be lower. We could, as a country, there are some structural things we could do to try to offset that, which I talked about.
Yeah.
But if you just confine it to monetary policy, we can't fix that. What we can do is we can try to help the adjustment to that lower. So in most of those simulations, what you see is that the demand slows faster than the long-run trajectory of the economy. So in other words, the economy kind of overshoots on the downside before it starts to come back to that new lower long-run path. So we can try to lean against that so that it doesn't undershoot too much. But at the same time, the implication of tariffs is costs will be higher for a variety of reasons. That will boost prices. That will boost inflation. And so we have to balance the support we can provide through the economy with the need to prevent inflation from an increase in the price level from becoming ongoing inflation. What we can't let happen is we can't let a tariff problem become an inflation problem.
Mm-hmm. Thank you. And I'm also thinking about Deputy Governor Rogers last year flagging productivity, and you mentioned it in your remarks as well as being a real need. And to your point, if we see a softening of investment, what does that say about how we're going to address productivity and how important that is? Do you have some thoughts on that?
Yeah, so as you mentioned, my colleague Carolyn Rogers, Senior Deputy Governor, gave an excellent speech last year. And she used this metaphor. So, we've all seen these signs, in case of emergency, break glass. And the thrust of her speech was, it is a break glass moment. Canada has suffered for basically since about 2000 from weak productivity growth. We have many great companies in this country that are investing, that are innovating, that are exporting, that are winning in world markets, but we don't have enough of them. And our average level of investment, when you compare it to U.S. companies, on average, Canadian companies are investing less. They're innovating less. And as a result, our productivity growth has been weaker. And productivity, it's a bit of an amorphous concept, but why is productivity growth so important? Well, for workers, productivity growth pays for higher wages. More productivity growth means people get paid more. For your businesses, it means you're more competitive domestically in global markets. You can expand your market. You can increase your profitability. For governments, it means that the tax base is growing without the cost base growing, so they can either cut taxes or improve services. And for monetary policy, it means the economy can grow more without inflationary pressure. So that's why there's this obsession with productivity. And what Carolyn was articulating about a year ago was we could see some of these structural headwinds. I mean, we could see protectionism was rising. We could see the tailwind of globalization was starting to reverse. And against that background, the imperative to invest in productivity becomes all the greater. Now, I think what we're seeing is that unfortunately those headwinds are accelerating very rapidly. And if there was ever a time to break the glass, it's now.
Right, point taken. And you also mentioned internal trade, labor mobility between provinces, and we've been down this road many times in terms of our policymakers and the business community really pleading. And we've got Dan Tish here, CEO at the Ontario Chamber, and both the Ontario Chamber and the Canadian Chamber are saying this is the moment to truly address this issue. We've seen some openness from premiers, and most notably the Nova Scotia Premier, and I think our Premier as well, being generally on side with reducing these barriers. But what do you think? Do you think that this is actually a time where we could see some real movement in this area?
I sincerely hope it is. I think, look, coming back to the issue of productivity, there are some structural features of our economy that we need to address, but we can't change them quickly. One thing you observe is that companies that export tend to invest more in new machinery or equipment. They tend to be more productive. That suggests there are some competition issues in the country. The other thing you see is that we're great at starting new companies. We have trouble growing them. We have trouble scaling them to create big companies. And we know that smaller and medium-sized companies don't have as many resources as bigger companies. They tend to be slower to invest in new technology, and so, not surprisingly, they tend to be less productive. Those are big structural issues, and we need to grapple with those. But that's going to be a long game. But there are some other things, and since we've just had an epic hockey game, I'm going to use a hockey analogy. I call them, we have these own goals. We have these things that we've done to ourselves that were well-intentioned, but they're having big costs. And in that bucket, and these are things we've done to ourselves, so we could undo them to ourselves. And in that bucket, I would put interprovincial trade barriers. We have many little regulatory differences between provinces that impede the flow of goods and services across the country because it adds costs. We could harmonize those, or even, if you want to do it even faster, we could just mutually recognize those regulatory differences across the country. There are procurement rules that prevent interprovincial activity.
Yeah.
There are,
and then the professional bodies.
They're the professional bodies. The provinces could get together and mutually recognize, reduce these trade barriers. That would make it easier to trade within the country. And if it's more difficult to trade with our southern...
Which it hasn't been up to this point.
If it becomes more difficult to trade with the United States, why not make it easier to trade within our great country? We could also invest in better transportation links, rail, pipelines, ports.
Isn't it true also for the struggle for talent? That if we're unable to move talent across the country?
Well, that gets to these labor accreditations. Yeah. Yes, I think you could make it. We've got provincial bodies for accountants, for lawyers, for electricians, for doctors, for nurses. If we could cut through that, it would be easier for labor to move around the country. That would improve the allocation. That would improve productivity.
Great. I want to move to a question related to monetary policy and its impact on sort of everyday Canadians. So just going back in time through the 90s and through to 2020, monetary policy was generally enacted in a period where inflation was low, economic growth was fairly consistent, aside from recessions of the early 90s and in 2008-9. During this period, inflation was low, and compared to the 70s and 80s, interest rates were low. When the pandemic started, this all changed, and Canada entered a recession. Inflation skyrocketed. We know the story there. At one point in time, the bank, I'm sure you didn't want to do it, but needed to increase rates by 100 basis points in July 2022. While the shock of that interest rate hiking cycle has subsided, it appears that we've transitioned to a bit of a cutting cycle. We'll see how long that might persist. But with this period upon us, are you concerned that Canadians have become overly accustomed to lower interest rates in the past 3 decades? And if so, what are the implications?
Well, we are concerned, and we've highlighted this now for a number of years, that household indebtedness in the last 15 years or so has increased considerably. And that means households in Canada are more vulnerable. If you've got higher debt, you're in a more vulnerable position. If something bad happens, you've got less resources to draw on. So that is something that it concerns us. It's something that we factor into the course of monetary policy. I mean, other things equal, if people are more indebted, it means they tend to be more sensitive to interest rates. So that's something that we factor into our analysis. As you mentioned, yes, we had to raise rates very forcefully to get inflation back down. I don't want to minimize the difficulties that created for many businesses, for many Canadians, but it worked. And we didn't cause a recession. Yes, the economy slowed. It actually needed to slow. The economy was very overheated. That was what was generating the inflation, in part. It needed to slow, but it slowed without causing a recession. We got inflation back down. We've now lowered interest rates substantially. That does mean that if you have debt, it's not the cost of that is going down, or when you renew your mortgage, hopefully it'll go down. But household indebtedness is still relatively high in Canada, and that is something that we have to keep an eye on.
Great. And how about moving from households to governments? We've seen Canadian governments of various types and levels increase their debt to GDP ratios. From a monetary policy perspective, are you concerned about this? And if it's not a significant concern, at what point does it become a concern?
Monetary policy is a big job. It's our job. Fiscal policy is also a big job, but it's the job of elected governments. So I try to keep in my lane in the hopes that they'll keep in their lane. There are some... So, in general, Bank of Canada governor does not comment on fiscal policy. There are some situations where there are exceptions to that. If fiscal policy was fundamentally unsustainable and debt was spiraling upwards and we were heading to a debt crisis, well, clearly monetary policy or nothing else is going to work well, and I think the governor of the Bank of Canada would have a responsibility to speak out. That's not the situation now, but we were in that situation actually in the early 1990s in Canada. Fortunately, we got scared straight and we learned our lesson. The other situation is where inflation's too high, the economy's in excess demand, the bank's raising interest rates to try to get inflation down, and governments are increasing spending. And that was, I did express some concern a couple of years ago. When inflation was high, we were raising rates forcefully. I did express concern that it would not be helpful if governments continued to increase spending and boosted demand at the same time we were trying to slow it to bring inflation down. Again, I mean, that's not the situation we're in today. Today, we've got an economy that we're back to 2% inflation. The economy actually has some excess supply. We've been lowering interest rates, so growth picks up to take up that excess supply. I'm in the space where I don't need to comment on fiscal policy.
Fair enough. With interest rates now stabilizing, how does the Bank of Canada assess the risk of another housing market surge? Are affordability concerns likely to persist?
Well, there's no question affordability concerns are here. They're real. And yes, they are likely to persist. I know I was looking at the numbers in the Mississauga area. It's a big issue in this region. Unfortunately, monetary policy can't solve that problem. We had very low interest rates, and we got a big increase in prices. We had higher interest rates. Prices, of course, stopped going up, but they actually came down a little bit. But, of course, the cost of carrying a mortgage went up, so affordability didn't get any better. And I think this drives home the point. We had an affordability crisis, affordability problem at low interest rates. We have affordability problem at high interest rates. Interest rates aren't the solution. The solution is increasing the supply. of housing. And for that, you really need all levels of government. It really starts with municipal, but provincial and federal as well, working together to, and I will say, we have seen a big shift across the country. Municipalities, provinces, and the federal government are working together to increase the supply.
Right.
But it's not a problem that is going to get solved quickly. If you've got a 10-year deficit
it wasn't created
of supply, it wasn't created quickly, it's not going to be solved quickly, but it does need a persistent focus to solve that problem.
Right, fair. And finally, our dollar currently sits in and around 70 cents to the US dollar. How does the bank see the Canadian dollar performing this year? I guess there's so much uncertainty around that. What impact will global trade uncertainties, such as US-China relations or shifts in supply chains, as you mentioned, have on our economy?
Well, a couple of things off the top. First of all, I want to emphasize that the Bank of Canada does not target the exchange rate. We target inflation. And in fact, the flexible exchange rate is part of that monetary policy framework that I was talking about. The flexible exchange rate actually allows us to run monetary policy that is geared to Canada. If we had a fixed exchange rate with the United States, we'd just have to do exactly what the Fed does. We would have to keep interest rates, and so interest rates would be a lot higher than they are now. The flexible exchange rate is an important part of our framework that allows us to run monetary policy geared to what the Canadian economy needs. The second
thing, for our exporters, enabling them to be more competitive on the lower dollar.
Well, a lower dollar has multiple impacts. Yes, it makes our exporters more competitive. It also makes Canadians buying things from other countries more expensive. So, it gives and it takes. The other thing I'd stress is that we don't forecast the Canadian dollar. When we run our forecasts, actually, we just hold the Canadian dollar at whatever it is. Having said that, look, clearly we've seen a material depreciation in the Canadian dollar. It was running around 74 cents. It's been about 69, 70 now for about a month. What has caused that? Well, interest rates in Canada have moved down quite a bit more than they have in the United States. That is weighing a bit on the value of the Canadian dollar, but our analysis is that that's actually effect is pretty modest. What's been having a much bigger effect is the uncertainty caused by tariffs. And if you look at when the Canadian dollar depreciated, the timing aligns very much when President Trump first began threatening significant tariffs on Canada. Where the Canadian dollar goes from here, that is a harder question. It's going to depend a lot on how things evolve. But look, I think the market has built in a certain amount of depreciation already based on the threat. If that threat crystallizes and there are significant tariffs, I wouldn't be surprised if you saw some more movement. Some of it's already built in, but the markets are going to react to information like everybody else.
Mm-hmm. I know that you're heading this weekend to G20, and I'm just curious, in speaking with your colleagues at other central banks and in the overall economics community, economist community, what are you hearing? What do you expect to hear when you're at the G20? Or is everyone just sort of equally uncertain?
Well, this will be the first major international meeting that I'm going to since the Trump administration has taken the presidency. So I expect, in Canada, obviously, we're very focused on trade. I think if you're in Europe, you're very focused on war and Russia's invasion of Ukraine, and where that process ends, how it ends, what the security situation is. So, there are, and that, we don't do security, but that also creates economic uncertainty. That has economic implications, certainly for Europe and indeed the world. So I expect, my expectation is these issues will dominate the discussion, but we'll see.
Great. And just to close off, anyone in your position, especially during these times, I feel, needs that time to kind of step away, recollect your thoughts. Just given, I'm sure, that anxiety and stress around the role. What do you do in your off time to just stay sane?
Well, I thank you for the sentiment. I am a true Canadian. I love winter. And I live in Ottawa. If you think there's snow in Toronto, there is twice as much snow in Ottawa. It's great. The thing about winter sports is they're so unique. And actually, the season is really short. So if the weather is good, as long as it's above minus 25, I'm going to get outside. I'm going to go cross-country skiing, downhill skiing, snowshoeing. I might just walk the dog. Like in
Your
Toronto,
dog might not like minus 25, but yeah.
he likes the snow too. Like in Ottawa, like in Toronto, we've got lots of outdoor rinks, play shinny with my buddies. We've got the longest, it's been a great year for the canal in Ottawa after two seasons where it barely opened. It's been open all winter. Ice has never been better. So yeah, get outside, breathe that cold air. That clears your mind.
All right. I love to close off with that kind of question because it really shows there's a human being behind the guy with the numbers, right? So thank you so much, and I believe that we're going to have our partners at FCT come up informally. Thank you.
So good afternoon. My name is Amélie Ferron-Craig. I'm a press officer at the Bank of Canada, and I will be moderating this press conference. So Governor Macklem is pleased to take questions for about 20 minutes. And before asking your question, please state your name and affiliation. So we're webcasting this press conference, so please use the wireless microphone that my colleague will be passing around. We also have several journalists participating remotely today. So we'll do one question in the room, and then we'll turn to the call to try to make sure that every news organization gets a chance to ask their question. And the governor will be happy to answer questions in both official languages. Alors, avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil et libre à vous de poser vos questions dans la langue officielle de votre choix. So we will start with Anna Pereira of the Toronto Star.
Hi, Governor. Thanks so much for taking my question. Oh, can you hear me okay? Thanks so much for taking my question. So many are expecting your next move to be a pause. Do you feel comfortable pausing interest rates if the 25% tariffs are imposed in early March?
Look, we're gonna take the decision in early March. The situation is clearly pretty fluid. Almost every day there's some new bit of information that's coming out. When we get to early March, we'll do our best assessment and we'll take our best decision. What I was trying to do today was really lay out how we're analyzing this, how we're thinking about it, what we think the effects will be on the Canadian economy. We took one scenario. There are many possible scenarios, and we'll have to look at exactly what information we have, and we'll take the best decision we can.
Thank you. We will now go to Tara Deschamps of the Canadian Press.
You spoke a lot today about interprovincial trade barriers, and I'm wondering if we were to loosen some of them, which do you think would be most impactful in improving the economy and fending off these tariff threats?
I actually think you need to look at them fairly holistically. I don't have an analysis of the effects of every single separate one. But I think think you're a business and you want to trade across the country. Well, if you have to comply to separate regulations in 10 different provinces and 3 more territories, that's going to raise your cost. And so that trade looks less attractive. Obviously, there are also explicit interprovincial barriers on trading some things, but a lot of it is many small differences in regulations that just raise the cost of that. If we could cut through that, get rid of those, that would it would reduce the cost of trading across the country. There have been estimates done by the IMF, by Canadian academics. I think I cite a couple in the speech. They suggest that the gains of doing this would be significant.
Thank you. We'll now go to Global News.
Afternoon, Governor. You mentioned in your remarks that even the threat of tariffs is impacting the Canadian economy negatively. Can you quantify the impact that it's having right now on investment?
I can't really quantify it. The data that we get obviously comes with a certain lag, so we actually don't have much official data since tariffs have been a serious threat. Certainly, we are stepping up our surveys of businesses. We are stepping up our regional outreach. We are talking to more businesses. We have something called the Business Leaders Pulse, which is a digital survey we do. And so we are in the process of doing that. And while that information is somewhat, every company has their own story. We will sort of add it all up. Certainly what we're hearing so far is many businesses are delaying business decisions, delaying investment decisions until they get more clarity. You are hearing some plans are being canceled. I expect when we get to the March our March decision, we'll have more to say on the add up of what we're hearing and what we expect to see in the data on investment. What I did today was I outlined, based on sort of historical relationships, here's, the kind of impact a trade conflict could have on investment. And, the message is investment is one of the places where you would see a very strong impact and a very rapid impact. And that is not surprising. If you're a business, a structural change means you need to reassess your whole investment strategy. And that's what you're seeing in these results I presented today.
Thank you. So we will now go to the phone line. I just want to remind people on the call to mute their line if they're not asking a question. So we will go first to Paul Vieira of the Wall Street Journal, then we will go to Mark Rendell of the Globe and Mail, and then Max Sato of Mace News. So Paul, go ahead.
Governor, if it weren't for the tariff threats, is it fair to say the economy is rebounding or on very solid footing, as you put it, and may not require further rate reductions?
Can you we missed the first part of your question there, Paul. Can you just repeat it?
Okay, sorry, Governor.
That's better.
If it weren't for the tariff threats, is it fair to say the economy is rebounding, showing encouraging signs, and may not require further rate reductions?
Well, Paul, I wish we were working in that hypothetical world. Sadly, we're not. So at a certain point, it becomes a bit hard to separate. We're already seeing the impacts of uncertainty certainly you're seeing it in business decisions. I think you're starting to, the latest indicators, pretty, more confidence type indicators, you're starting to see some effects on household confidence. So consumer confidence. So it's a bit hard to separate. Look, coming back to your question and, going back to our January decision, yes, we were encouraged. Inflation's back to 2%. We've lowered We've lowered interest rates now 2 full percentage points. We are seeing that flow through to stronger household spending. You've seen some pickup in the housing market. You know, and the message in January is we wanted to see that sustained. That's why that was certainly an important reason why we took a further step down in the policy rate to 3%. You know, it's difficult. It becomes difficult to separate, separate what could be from what will be. We're going to have to deal with the facts on the ground, and just the threat of tariffs is already feeding uncertainty. It's already affecting the economy. It's already doing damage.
Thank you. We'll now go to Mark Rendell of the Globe and Mail. Go ahead, Mark.
Thanks for taking the question, Governor. In the event of a trade war, one of the key things pushing up prices in Canada would be retaliation, the fact that Canada theoretically would retaliate, as has been outlined by the government, against U.S. imports. I'm wondering, from a purely economic perspective, putting aside the politics of it, but from a purely economic perspective, should Canada retaliate to tariffs, or does that do more harm than good? And as a second point, if we do retaliate, are there ways to do it that are less damaging to the Canadian economy?
Mark, well, the first thing I really want to stress is, look, Bank of Canada, we do not do trade policy, and decisions about tariffs are not up to us. These are decisions that are up to the government, to Parliament, and you know, that is completely appropriate. To get to your question, look, why do you retaliate? You retaliate to increase the costs on the United States. Let's not forget that U.S. tariffs on Canada, they hurt Canada more, but they also have an impact on the United States. They make all Canadian imports into the United States more expensive. That's going to affect U.S. businesses. That's going to affect U.S. consumers. By imposing retaliatory tariffs, we further increase the cost to the U.S. economy, because now American exports to Canada are more expensive, so they're going to go down, and American companies are going to feel that. Yes, that will have some impact in Canada. Unfortunately, the nature of conflict is that, you take some costs. You do that, though, because you want the Americans to back off on their tariffs. I don't know what's going to happen this time, but last time when the U.S. put tariffs on aluminum and steel, Canadian government retaliated. That did appear to have some impact, and those tariffs were ultimately removed. So again, I don't know what's going to happen, but the nature of a trade conflict is you want to get to a better place. You want to get back to a place where you can have more open, more predictable trade, and that's why you respond.
Thank you. We'll now go, to Max Sato of Mace News.
Thank you, Governor. When you try to measure the impact of the Trump tariffs on Canadian exports at the Bank of Canada, is it possible to separate exports by U.S. companies based in Canada from those from purely Canadian companies?
I think I don't have a detailed answer to that question. It's not possible. I don't think it's possible if you just look at the national accounts. We do have some more detailed data. You could probably make an attempt at that. I'd have to look into it in more detail.
Thank you. We'll go to Greg Quinn of MNI.
Good afternoon. I wanted to ask about the part of the speech where you compare the potential damage of a trade war to kind of the COVID economic cycle, the slump there. during, you mentioned that one difference this time is there's no clear rebound if a trade war is sort of semi-permanent or ongoing. But I just wondered about the analogy there in this sense that in the pandemic, obviously interest rates went to effectively zero, and then we unleashed quantitative easing and did other things, used the whole toolkit. Can you clarify, you said, of course, there's inflation tension on the other side of this one, but where's the boundary here in terms of how far we went in the slump related to COVID and how far we might go in a downturn related to trade?
Well, Greg, yeah. I mean, you come back to where I started. COVID, yes, there were both demand and supply elements. In that sense, there is some similarity. But there are very big differences because in COVID, demand, it was a very, very sharp, very sudden shutdown of the economy. Demand plummeted. We had the deepest recession on record. And supply also was constrained because obviously many things were closed because we had to prevent the spread of the virus. What's different about COVID is that things reopened. And as the economy reopened, there was this huge bounce back. We had, the most rapid recovery ever. What I was trying to highlight is that in the case of a trade war, there's no bounce back. If you introduce tariffs, the economy works less efficiently. We don't get those economies of scale. Businesses can't grow their businesses by growing their exports to the United States. So they're going to invest less. There's going to be less production. Incomes will be lower in Canada. And unless we introduce a new structural shock, some structural reform that boosts our potential output, but boosts supply, there's no bounce back. So what that means, for monetary policy, we can't change that reality. The economy is going to a permanently lower path. So the only thing we can do is we can help smooth the painful economic adjustment to tariffs. But even there, monetary policy is constrained because we have to make sure that the tariff problem doesn't become an inflation problem. So what that means is you're not looking like a COVID-type response. We're going to have to proceed quite carefully. We're going to have to balance yes, there will be downward pressures on inflation from the weakness in the economy, but there's going to be also upward pressures from higher import costs, a weaker Canadian dollar, inevitable supply chain disruptions. That'll all increase cost, and that'll put upward pressure on inflation. So we're not. I mean, what I was really trying to convey in my remarks today is we're not thinking of a COVID-type response here. It's a different shock.
Thank you very much. We will go to Pramit Mukherjee of Reuters.
Good afternoon, Governor.
Hi.
Can you hear me, right? Yeah. Okay.
I can hear you.
So I wanted to ask that in a time of such uncertainty, when there is trade uncertainty, geopolitical risks, there's risk of wars and everything, don't you think the central bank, that is the Bank of Canada, should take a bigger responsibility and have a broader mandate than just focusing on 2% inflation?
I think monetary policy needs to focus on what monetary policy can do. And monetary policy can control inflation over time. And one thing we hear very clearly from Canadians is they don't like inflation. I don't think allowing this tariff, this trade structural change to become an inflation problem is only going to make a bad problem worse.
Thank you. We will go to our last question from Randy Thantong-Knight of Bloomberg.
Hi, Governor. Are you concerned with the recent run-up in median and trim core inflation? And do you still have faith in both of these measures as accurately representing underlying price pressures?
Well, as you, I think, are alluding, the latest CPI data, total CPI inflation came in 1.9, core, above 2.5 now. So, look, we're obviously watching that closely. I think if oil prices had stayed lower, you would have expected headline inflation to come down a little bit more with the GST holiday. The effect of the GST holiday, when you look under the hood, it's there, but the higher oil prices in January have sort of offset much of that. So inflation hasn't really changed very much in the last few months, been running just below 2. Looking forward, you never know what's going to happen to oil prices. They have come back down somewhat in February from where they were in January. They're still a little bit higher than they were in December. We'll see where they go. But that decline in global oil prices should be reflected in inflation going forward. With respect to core, yes, we did in the monetary policy report explain that when you look at a broader set of measures of underlying inflation, we're not seeing, underlying inflation looks like it's a little over 2. It doesn't look as high as our preferred measures of core would suggest. And what am I talking about there? If you look at the whole distribution of price changes, if you look at the share of CPI components rising faster than 3%, it's looking pretty normal. It did tick up a bit in January, but it's still looking pretty normal relative to history. With respect to our core measures, the fact that we've had this sustained pressure in shelter cost, that is having some effect on our core measures. It's taking a lot of the space in the right-hand part of the distribution, if you want to get a little bit technical. So the other things that are high don't get taken out as much as normal. So that's causing the preferred measures of core to run a bit high. So look, it's on our radar screen. We look at a variety of measures of underlying inflation, and we're watching them carefully. We'll continue to watch them carefully. But there are some technical features of the preferred measures that suggest that might be a little bit overstated.
Thank you very much. That's the time we have.
Thank you.